All right, everybody. You can all see the spreadsheet on the board here because we're going to review the PayPal broken wing fly spread that we put on this morning. Okay? Everybody see that okay? Great. So here's the scenario. We bought the June 14th 112 call, sold 2 of the 117s, and bought 1 of the June 118. We paid $1.30. Actually, we wound up paying, the signal, was for $1.20. I know most of us paid less, but we're going to use $1.20. I know most got in for less. Okay, so down here below any of the strikes, so up to what I have here as up to 111, we can only lose what we paid. Okay, the 120, that's the max we could ever lose. Okay, same at 112, even if we only go to 112, everything is then worthless. Okay, at 113.20, whoops, that would be our break even. And I just realized I need to change these strikes right here. Okay. So break even would be at 113.20. And you know what? Maybe I'm confusing the two because we had them out so quickly back to back here. The Baba and PayPal. Yes, 135. There we go. It was not Baba, Adobe. It was Adobe that we got in better. Okay, so now, thank you for correcting me there. Now that makes the maximum loss there 135, 135. 135 and 135. And now the break even then would be 113.35. Okay, everybody see that? Everybody with so far? Okay, good. At 115, these would be 3, the others would be 0, so we would have a gain of $1.65. At 117, which would be ideal, obviously that's the short strike. That's going to be ideal there. Okay, 118. You can see the profitability start to go down a little bit. 120. And that is, yes I am, David. And that is the minimum it would ever be worth to the upside as we get through all of the strikes. Okay, so now what I want to do after I get all these up here, there we go. Now what I want to do is, like I said, one of our members here wanted to talk about a broken wing fly, and we can do it in PayPal here, for a credit, adjusting strikes the other way. Okay, so what he was looking for was, let me copy all this here actually, and I want to show you where the risk comes in. Okay? All right, thank you for that, Gus. I'm calling Gus out, but in a good way. Gus is the one that brought this up, so we can all thank Gus because it's actually very helpful. Carson, they all are. Yes, this will be posted up in the room via video, but all of these spreadsheets are also posted in the room when we go through them. So when we're finished, you will see. Okay, so what Gus wanted to do, and Gus, correct me if I'm wrong, was sell a 112 call, right? Or you wanted to buy that, sell the two. Okay, got it. He wants to buy the 112, but then sell two 114s, okay? So $2 wide on the long part of the butterfly, but then instead of being, in our case, looking at a broken wing where we'd maybe buy the 115 here, or if it was a regular butterfly, we'd buy the 116. What Gus is looking at is buying all the way out to the 119. So not only just reducing a debit, but actually turning this into a credit. Okay, so we have a long $2 wide call spread, right? The 112, 114, and then the other part of this butterfly is a short $5 call spread. Okay, and this would be done for a credit, Gus, you're saying, of 27 cents. Okay? Now, below any of the strikes, just like in the example of our long broken wing fly, everything is going to be worth 0. However, in this instance, we actually collected a credit. So this would be plus 27. So this would all be in the green here, not in the red. Okay, so anything from the first strike below, all the options are worthless, but we collected a credit, so we keep the 27 cents. Now, just like every other trade, the fact that we still want the stock to move to the short strikes is still what we want to happen. I gotta change this to 114 and this to 119. Okay, so at 114 now, this should actually be 114. That's going to be the max that we could ever make on this. So our long call's worth 2. The others are all worth 0. However, not only is the long part of the butterfly worth $2, we also have our initial credit. So a max profit there of $2.27. Okay? But now is where it starts to get dicey, because rather than being in a symmetrical or even a butterfly where the long portion is wider than the short portion, now the spread's going to start working against us. We're not even talking about expected move right now, Peter. Okay? So, at 115, that's going to be worth 3. Those are going to be worth 1 each. The 119s are going to be worth 0. Still going to make money there. But watch what happens here. Let's change this to 116, then 117, then 118, because I want to really break this out for you guys to see what happens here. Okay, at 115 we got that. At 116, these are worth 4. These are worth 2 each. The 119s are still worth 0. So the entire spread, the broken wing fly, is worth 0 at that point, but we still had our credit. Okay, so we're still in the green there, but now watch what happens. Here's where that risk starts to come in. 5, 3, 0. We now start to go to a loss. Okay, 118. Whoops. $119, which is right at the last long strike. Okay, and then that would be the maximum loss from there on out. Actually, no, excuse me. I take that back. I'm thinking about the long fly again. Remember, we're doubly short calls here. Okay, so this is actually, should be plus, there we go, sorry about that. So we're going to see now this loss maxed out here, because everything is all going to work now in concert with one another. 9, 7, 2, and then this is still plus 27. Okay, so here's the difference between the credit you're collecting in this broken wing fly, because we're selling a wider spread than what we're buying, as opposed to the debit spread up above here. Now, the debit spread up above here, you can see, is obviously constructed to be a bullish play, right? Because the profitability is all on the upside. This broken wing fly, even though we're buying the first part of the spread, the 112, 114, which is bullish, the second part of the spread, the 114, 119 short part, because it's wider than the long part, takes over, adds actually negative delta to the spread. So you can see here, even though it's mildly bullish, right? If the stock goes down at all, great. We don't care. We keep our credit. It is mildly bullish, but then on a bigger outsized move to the upside is when that starts to kick in. So, listen, it's certainly a valid strategy. I'm not saying never to do that. I don't want to have this risk here for a 27-cent credit. to start the day with. That's just me. Gus, does that help you out? What do you mean, what happens in the meantime? What do you mean by that? Well, the most you're ever going to make out of this, okay? The most you're ever going to make out of this, unless the stock goes to the short strike, is really your 27 cents credit that you have. Okay, it's hard to value because then you have to look at other factors like volatility. It's hard to value where these options would be in the middle, in the cyberspace between now and expiration. Can't do it on a spreadsheet like this. I can do it on the risk graph in our trading platform. I can't do it on this spreadsheet. Remember, this spreadsheet only calculates mathematically at expiration. Doesn't really matter, Gus, because a broken wing fly like this is going to be fairly neutral volatility. Though in this case, because you're short two at the monies or closer to being at the money and then long that one out, you actually will be short some volatility to this trade. So if volatility went up, that would be a negative for you. Okay. Sell which call spread, Gus? Or Glenn? Sell which call spread? So if I sell that, where's my risk? And what is my risk? Now I have a massive amount of risk. Okay, I can make, no, I'm not risking 5, I'm risking 4. I can collect $1, it can go to 5, so I'm risking 4. If you're bearish or if you don't think that the stock is going to go up there, then you can do something like that. I'm not willing to lay 4-to-1 odds against me, to do that. Okay. What do you mean using a debit spread in this case? What I don't understand. Well, a debit spread, any type of spread is always going to define your risk. It all dependent upon the risk that you want to take. And that's why not that they're the end-all be-all, but I have certain reward to risk measurements. Because everything comes down to the appropriate reward you get paid for the risk that you're taking, whether it's a credit or a debit spread. Yeah, the 112, 114 is a hedge, yes. That part of it, yeah. If you break it down, that's a hedge against the short 114, 119. Absolutely. That is absolutely a right way to look at it. Okay, does this help everybody out? I'll post that up in the room here, Gordon. What is what called, Mike? This spreadsheet or this type of trade? The bottom part, well, the original signal that we sent, that we bought, is a broken wing call butterfly. The bottom part is a credit broken wing fly. They're both broken wing flies. Just one is a debit, one is a credit, and you just set them up with different increments, different widths between the long and the short portions of the trade. Okay? All right, let me get the video wrapped up here. I'll get this posted up here. And I'll be right back. Gus, thanks for bringing that up. I think that helped a lot of people.